Yeah, hi everyone. Thanks for joining me here today. I'm Mark Phillips, the founder and principal at Harvested Financial, and also the producer of the Tape Report. And so while I am a financial advisor, I'm not your financial advisor. And this report and discussion and video today do not constitute financial advice. If you have any questions about that, please check out my homepage at harvestedfinancial.com. But today we're here to talk about, for educational and informational purposes, the StableSkew report. And this is actually one of my favorite reports on the tape because it tells so much about what's going on with the options pricing. The skew curve really explains how the surface is moving at different deltas and days to expirations. So what stable refers to here is the fact that we plot implied volatility on the vertical axis against a stable delta range on the x-axis. So instead of saying what's the volatility at this strike, we normalize that to delta space. We also normalize across time and use a fixed expiration to compare to. Now we can compare both deltas across individual names across time and across expirations, but also against issues. What is SPY vol doing versus what's Apple vol doing? So we have our delta space on the horizontal axis, and then we can choose different stable expirations. Am I looking at 10-day vol today versus 10-day vol yesterday? And so we have 10, 30, 60, 90 stable expirations. The other parameter that we use in this basic mode is the averaging period. So in the dark green line, I have SPY at 30 days compared to the average over the last 10 days in the lighter green. So we can see the curve's down a little bit, maybe a little bit more on the downside than the upside, but overall the curve's in a little bit. If I want to look at a different name like Apple, I can also compare against SPY. So what's the broad market doing versus what's Apple doing? In this case, Apple's actually down a little bit, 30 days. They have earnings this Friday, so that probably explains why they're not down quite as much as the overall market. But the other mode we can engage here is history mode. So if I want to look at what was Apple doing back in August, we have the last 90 days here, so we can pick any trading day going back in history and say, what does the implied volatility curve look like at that point? Again, all normalized against delta and implied volatility levels. So we have Apple here. I can compare it to what SPY looked like on that day. So again, Apple going to be a good click higher, SPY going to be a little bit lower there. We might want to again compare it to the current curve. So here in those green and blue, we see what Apple is doing. Of course, that blue curve is going to be a little bit more skewed up to the downside, a little bit more risk with earnings coming in compared to August 3rd, which was just a relatively normal day. Market was a good bit higher then also. And then we can also, of course, for context, add the current SPY curve to the whole setup. So what all these different data points show and tell us about the market is really an important part of the opportunity process. If you came here because liquidity was interesting and you noticed something about increased activity, you might say, well, how's the skew curve changed? You might look at the history because you want to contextualize what the market's actually done compared to what the market was pricing it would do. So by that I mean, if I look at SPY on August 3rd, 2023, SPX was around 4,500, SPY would be around 450 then too, 449. If I look at the 50 delta call on August 3rd, I can see it was 12.3, and I can see the 50 delta call is like 17.3 today. Vol's up 5 clicks. If we just measure at the money vol, this is 10 days to expiration. If we just measure at the money vol 10 days out, it's up. But given that stock's gone down so much, how much are we really up? So to answer that question, we'd say, well, on August 3rd, the 4,200 put would have been about 20 delta. I went and looked that up. And so about where we are right now was about the 20 delta probability on August 3rd. On August 3rd, the 20 delta probability option was pricing around a 16.1 vol. So when we were at 4,500, we thought the volatility would be about 16% when if we got to 4,200. Today it's 17.3 at that 10-day range. So 10-day range is slightly higher than we expected it would have been then. If we look at the 30 days to expiration, it's actually not that much different. We priced the 20 delta at 16.2. It's about 16 right now on the recent curve. So these are sort of the differences between movement along the curve and movement of the curve. But what's important here from an investor perspective is, okay, we're down a lot. Valuations are down. But is the market moving any more volatilely than we would have expected? To the extent that there's a little bit more panic, yes. But we also just naturally expect volatility to float with price action. So that to me as an overall investor might give me a little bit more certainty despite the fact that you're seeing red in the account. The other way you can use StableSkew, getting out of history mode, is going back and seeing how something's priced relative to the opportunities and why that's alerting. If I saw a downside getting bid up in Apple for some reason, I might look at the curve and see how much it really is, or see how much it's moving compared to SPY. So all of this kind of loops into that whole opportunity process where I might be identified to something. I'm going to analyze what's going on with the curve at different dimensions. Am I really selling the fattest part? An expensive put pops up, for example, and says Apple puts are expensive. Well, I actually see that it's not the out of the money that's the most expensive. It might be the at the monies in certain examples. So StableSkew will add a lot of context to your alerts, help you really analyze what's going on with the market. And then you can feed back into practical spreads to put on a trade. If I see downside being more expensive, I might go to my fixed delta spreads and look at put verticals, at the money or out of the money put verticals. If I see the overall vol curve is more expensive, I might go for something like a butterfly or a condor. So integrating StableSkew into your opportunity discovery process is a really important part, and just these few little lines can tell so much about what's going on with the volatility surface. Thanks for tuning in, and most importantly, if you like what you saw here, make sure to subscribe. Make sure to hit the like button and share it with your friends, because the more people that are learning about options and trading them, the better markets we all have.